your agenda too. It's time to look back on your portfolio's performance and plan for the year ahead. It's been a solid year for many, with all three indexes heading for triple-digit gains, and with the right mix of stocks, we might make 2025 a winning one too. Most importantly, though, remember to focus on the long term, as gains over a number of years are what we're really looking for. So don't worry if your portfolio hasn't performed as well as you'd hoped during any particular year, including this one. Need some inspiration for stocks to buy right now? Here are my top 10 buys, in no particular order, for 2025 and beyond. Most of these stocks have a solid earnings track record, except for the clinical stage biotech that doesn't yet generate product revenue. And they all have bright long-term prospects. 1. NVIDIA. Even though NVIDIA minus 2.09%, has soared more than 160% this year, I still think this player has room to run. A key catalyst is unfolding right now. This top artificial intelligence, AI, chip designer is ramping production of its Blackwell architecture, and demand is staggering, the company has said. Blackwell is expected to add billions of dollars to revenue in its first quarter of commercialization, with a gross margin of more than 70%. NVIDIA's commitment to innovation should keep it ahead of rivals, making the stock look reasonably priced today at 43x forward earnings estimates. 2. Pfizer. PFE 0.23%. Shares have struggled as the company's blockbuster coronavirus products saw steep declines in demand. But Pfizer has shifted focus to a huge batch of new products, with the launch of 19 in a period of 18 months, and its growing oncology business. Last year, Pfizer acquired Seagen to strengthen its oncology presence, and it set big goals. The company aims to launch 8 or more blockbuster oncology medicines by 2030, and it wants to double the number of patients taking its oncology drugs. This represents a potential new wave of growth ahead, making now a great time to get in on the stock. 3. Viking Therapeutics. VKTX minus 3.56%, is working in the hot growth area of obesity treatments. The company hasn't yet commercialized a product, but it's about to enter phase 3 trials with VK2735. This candidate belongs to the same class of drugs as blockbuster Zepbound, made by Eli Lilly, but demand is so strong in this market that there's room for several players. The company has catalysts in the form of clinical trial data reports that could offer the stock direction in the coming year. After a positive report earlier this year, the shares soared about 120% in one trading session. This may not be the case every time, but if VK2735 continues to deliver encouraging results, Viking could climb in 2025. 4. Amazon minus 1.45%, is an early winner in the AI space. The company uses AI to make its e-commerce operations more efficient, and it sells AI products and services through Amazon Web Services, AWS. And the reason to buy Amazon now? Its AI investment is starting to bear fruit. On the e-commerce side, Amazon is lowering costs to serve as it improves operations across the fulfillment network, for example, bringing inventory closer to customers. And revenue at AWS is taking off thanks to AI demand. In the recent quarter, AWS reported a $110 billion annualized revenue run rate. Amazon already is a leader in e-commerce and cloud computing, and it's heading for dominance in AI too. 5. Etsy, ETSY minus 2.10%, sells mainly discretionary items, so it struggled during times of higher inflation, as consumers had limited buying power. But it could make a big comeback as shoppers start spending more in a stronger economy. What I really like about Etsy is its capital-light business model. Etsy provides an online platform for artisans to sell their wares and for us to buy them. But Etsy doesn't take care of the stocking and transport of items, keeping its capital investments low. This allows Etsy to turn most of its adjusted earnings before interest, taxes, depreciation, and amortization, EBITDA, into free cash flow, 90% in the recent quarter. The stock trades for only 13x forward earnings estimates, so it could be a great time to stock up on Etsy. 6. Vertex Pharmaceuticals. Vertex Pharmaceuticals, the RDX minus 0.46%, is a proven leader in the cystic fibrosis, CF, treatment market, with its CF drugs bringing in blockbuster revenue year after year. The company has shown investors that it has what it takes to expand into other areas too. It won approval for a blood disorders treatment a year ago, and now it's awaiting a regulatory decision on a potential drug that could be big for the company. I'm talking about sezatrigen for moderate to severe acute pain. Vertex sees the potential product as a multi-billion-dollar opportunity, considering the limited options for pain treatment today. The company expects a regulatory decision next month that, and a potential launch, with revenue growth to follow, could make Vertex a winner next year. 7. CrowdStrike. CrowdStrike, CRWD minus 2.76%, is a top cybersecurity company that met a major headwind this year. A faulty software update from CrowdStrike led to the biggest information technology outage ever. This is weighing on earnings as the company offers customers compensation packages, but these packages also are encouraging them to expand their contracts with the security giant. So, over time, this gift to customers could bring in more revenue for CrowdStrike too. Importantly, CrowdStrike's clients stuck with it after the outage, and annual recurring revenue continues to advance in the double digits. The company expects the impact of the outage to lessen by late next year, opening up the door to more growth down the road. 8. Abbott Laboratories. Abbott Laboratories, ABT minus 0.24%, may not have one precise catalyst coming up, but its diverse businesses and dividend payments make it an excellent addition to any portfolio. I like Abbott's structure, with businesses in medical devices, diagnostics, nutrition, and established pharmaceuticals. This range of operations means that if one area meets headwinds, others can compensate. This has been the case recently. Diagnostics revenue slipped as COVID testing sales fell, but medical devices sales advanced in the double digits. Abbott has increased its quarterly dividend payout by 60% since 2020, and the company's track record of boosting its dividend for more than 50 years suggests rewarding shareholders remains a priority. 9. American Express. American Express minus 0.97%, is another top-performing stock this year, advancing 60%. The credit card giant makes money through membership fees, interest on customer balances, and transactions at merchants accepting the card. Its position in the premium market has proven to be a winning strategy over time, and growth of the younger audience says that could continue. In the recent quarter, American Express said millennial and Gen Z customers make up 80% of new U.S. consumer gold card accounts, and this is the fastest-growing consumer group for American Express in the U.S. In the quarter, the company reported record revenue of $16.6 billion, and card fee revenue and member spending both gained. So, this well-established company could offer plenty of growth ahead, powered by a new generation of consumers. 10. Palantir Technologies. Some say Palantir Technologies, PLDR minus 3.72%, looks expensive today, trading for nearly 200x forward earnings estimates after soaring more than 300% this year. But it's important to consider the company's growth. The AI-driven software player has seen sales to commercial customers take off, even as its traditional government customer revenue continues to climb. In the recent quarter, U.S. commercial revenue rose 54%, and U.S. government revenue increased 40%. On top of this, Palantir reported its highest quarterly profit ever. Considering it launched its artificial intelligence platform just a year ago and commercial customer growth seems to be in its early days, this stock could have much farther to go over time.